in any case, Neelkanth, how influential is government capex? You know, because all of us get excited when we hear that government capex is going up 25%, 30%. But compared to the size of government capex as percentage of overall GDP and compared to private capex, do you think it really has the kind of firepower to galvanize a proper capex cycle in this country?
A very important question. So if you think through, so let's remove that 1 trillion rupees that the states have to send. It's more like a blank check, and we'll figure out how fast it is spent and what it is spent. But if you see the increased allocations where we have some data, so there is about 15,000 crores, 150 billion rupees on the Nal Se Jal scheme. There is another 15,000 crores on defense capex. There is about 30,000 crores odd on roads and rail. Now, all of this is 60,000 crores, which is a lot of money, right? But remember that FY23 GDP is going to be 260 trillion rupees. So 0.6 trillion of capex is not really going to move the needle. So I think what the commentators are excited about or consider to be positive is that instead of targeting near-term growth, right? So one of the classic problems which theoreticians have been highlighting with governments is that the temptation to spend other people's money, right? That you because of the monopoly on violence, the state takes the taxes and then decides to spend as it wishes, and that wish is thankfully focused on long-term productivity building projects rather than just distributing the cash in subsidies or just cash handouts. And so the fact that the government sort of did not fall prey to those inclinations is something which is positive. The fact that it wants to spend productively is also very positive. On a macro level, though, and you're absolutely right, I think it is the processes, it is the aggregate end demand which actually will drive the private sector capex, which tends to be a lot higher in terms of a GFCF. So just to give you numbers, in gross fixed capital formation, so if the total number is say 26 or 27% of GDP, about 7.1, 7.2% of GDP used to be, this is a pre-COVID state, was the share of the government, state plus center plus PSU. So about 1/4 of the total GFCF was driven by the governments. If this 7% goes to 8%, of course it is reasonable and substantial, but not substantial. But it is not enough to drive the private sector capex cycle. But the good thing is that the other two elements of GFCF, so there's a private corporate GFCF, household sector, which is the residual. So the private sector GFCF actually has held up. So I am surprised when I hear that private corporates are. If you see the government data, the CSO's data on GDP, you will find that private corporate investments, which are actually a data-driven thing, right? MCA21 database, the 500,000 companies aggregate capex. So that number as a percentage of GDP is actually not slowed that much. The problem has been the household sector, where a lot of it was slowed down in dwelling construction. And so if we assume that the dwelling construction market is picking up, and I do believe that it is picking up, so there are very visible signs that we are starting a 3, 4, 5-year cycle. So then aggregate capex should be well supported. So there are many reasons why outside the budget, we should still be positive on investment activity.
So would it be a fair assumption? I mean, on the day of the budget, very simplistic assumptions are drawn because people are basically shooting off the cuff. So they hear capex and they say we should buy cement stocks and construction stocks because those will do well in the coming year. 1 week after the budget has been done and you've looked at the fine print as closely as you have, is it still a fair assumption to say anything to do with capex or construction should actually do well this year?
Well, cement and industrials and financials were sectors that we have been pushing now for several months. So it kind of supported our call, though I agree with you that if $500 billion or say even 1 trillion extra rupees are spent by the government, it doesn't really move the needle on the aggregate number that much, right? Especially as quite a bit of that capex may not necessarily be about cement, and it may not necessarily be about capital goods that where the order flow is. If you see the order flows that are coming through for the capital goods companies in this quarter, right, in the December quarter, and this was well before the budget, the execution and the revenues are well tepid to in line, but the order flow is surprising on the upside, and that holds true for a whole range of capital goods companies.
Crib that a lot of people had after the budget is that you are dialing back revenue expenditure, which is fine, but do you have concerns about whether demand will come back in the second half of the year quite so strongly, will follow through after the initial rebound trade is over? Do you worry about consumption demand, and does that color your judgment about how to approach discretionary and FMCG through FY22?
No, the short answer is no. I don't worry about it, in the sense that, see, there are many levers in terms of from here onwards that still have to play out, right? So, and the first and most important is that there are many low-income jobs that have still not come back. The schools are just starting off, and there are lakhs and lakhs of school teachers who used to earn 12,000-15,000 rupees a month, and where the school fees would be 300, 400, 200 rupees per month per student. Those schools have been shut for 2 years. The auto drivers, the rickshawalas who would ferry those kids to school, the uniform makers, the bag makers, the shoe makers, and all these kids will need new shoes and new uniforms and all that. So all of that yet needs to happen. As offices restart, we are going to have office boys, receptionists, the dabbawalas, the food delivery. The other day on budget day, they need those fast internet connections and data sharing for responding to the budget documents. And the building, they were cribbing that for 2 years they've had no business. So I think as the economy opens up, you will see a new surge, and I think a lot of that will be low-income consumption, because this will be, or say, travel and tourism. Like, so Australia is now opening up for business, and I think the vice versa trade, the travel will also pick up. And just to give you things in perspective, $27 billion was the amount spent by foreign travelers, which is almost 1% of GDP, coming to India, and that had fallen to nearly zero. So there is a lot more that needs to happen, and almost all of that will be in low-income consumption, or the low-income earners, low-wage earners. Even the restart in construction activity. So October, November, I think November we saw a bit of a lull, but then since then I think the incremental volumes are picking up. The incremental order flow activity levels are much better in January, and as the economy keeps opening up, I think you will see consumption revive.